There's actually a lot to talk about with you, Spencer. I actually want to start with real estate because I just called out Zillow there. You were involved with OfferPad coming to the public markets. And I'm curious about the impact of this quickly slowing housing market, rising rates on consumer behavior when it comes to retail investors and when it comes to some of these companies. What are you seeing?
Well, unfortunately, I think the housing market's a little bit worse than most people realize, because when you look at data like Case-Shiller, that tends to be a paired sale methodology, which means Case-Shiller looks at homes that sold in the period, say last month, and then it looks back at when the last time those homes sold 3, 5, 10 years ago, and it calculates the delta. But if you look at the median value of all homes in a geography, that's actually declining in many parts of the country. So housing is very weak. That's to be expected. The Fed wants this when they raised rates from, or when mortgage rates went from 3% up to the mid-6s on their way to the mid-7s. This is what you'd expect would happen, and it is absolutely happening. So housing is slowing rapidly. However, homes are still selling pretty quickly. And this is a bit of a mind bender. I think some people have a hard time wrapping their mind around. The reason for this is there's very limited inventory because of mortgage rate lock-in. So if you bought your home 2 years ago, 4 years ago, 10 years ago, you probably have a 2, 3, 4% mortgage, and it's very difficult for you to list your home now and buy at a 6 or 7% mortgage. So there are very few sales. There's not much inventory. Those homes are selling quickly, but the median home value is probably declining in lots of parts of the country.
All right, that's the state of real estate listings. Let's talk about stock listings.
Yep.
There's limited inventory of those too, but of new ones, but for different reasons. When do you expect that to shift? And what are you doing when it comes to your own investments and SPACs? You dabbled in that.
Yeah, so the IPO window now has been closed for 238 days. We haven't had a tech IPO greater than 50 million in 238 days. We've had one tech IPO this year versus 124 last year. So the window is slammed shut. I think it's going to stay closed until at least Q1, probably Q2, or maybe even Q3. And that's a pretty bearish point of view. But when you hear the Fed indicating that they're probably going to be raising another 50 to 100 plus basis points, that's going to slow the economy significantly. And you have to remember, like, we talk about the IPO window and IPO backlog as if it's some discrete thing, but really the IPO market is just a little microcosm of the broader equity market. So look at the comps, John. So online retail down 70% last 12 months, online advertising down 55% last 12 months, digital marketplaces down 40%. So when you've got these public comps that have come way down, public market investors looking at new issuances, looking at IPOs, they expect a discount to those public comps because they're taking a risk buying a new issuance, a company that hasn't been public previously. And so when public comps are down that much, the IPO window is going to be slammed shut because companies don't want to sell into that buzzsaw. Yeah. So unfortunately, look for it to stay closed at least until next year.
Well, to that point, Spencer, you are seeing some private companies take down their internal valuations, like an Instacart, which reportedly is still getting set to IPO later this year. So what will it take to open back up? Someone's got to go first. It's got to be a big name. Is that going to be Instacart?
Yeah, so I mean, I hope Instacart gets public this year. I'm pretty skeptical that they're going to get out this year. So in a normal market, you would look for, like, what does it take to be a good IPO candidate? You'd look for a company's ability to forecast, generally high growth, generally revenue scale, at least 100 million of revenue. In this market, you also need profitability or nearly profitable, especially unit level economics, unit level profitability, but ideally real profitability, and a bigger market cap, at least a 2 billion plus market cap, and then a marquee must own name with retail interest. So Instacart checks a lot of those boxes, but very little happens, very little equity issuance, even in a good market, happens between Thanksgiving and the end of the year. So if Instacart's going to get out, they have a very short window here, really just a couple weeks to get out before Thanksgiving, and I'm pretty skeptical. But what will reopen the market, I believe, sometime next year are going to be companies that meet these descriptions that I've just given. So forecastable, high growth, but most importantly, profitable, and that's new. We certainly haven't seen that in the IPO market for a couple of years.